Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies SOFI stock, and we're going to be going over the good, the bad, and the ugly. In today's video, we're going to be analyzing three articles. The first article is about why the share price of SoFi has actually dropped recently, which is exactly what I predicted in a previous YouTube video regarding how SoFi Technologies would actually have to pull back or crash before it starts to appreciate again. So literally that's falling right in line with our prediction. After we analyze this article, we're going to move on and we're going to talk about the best fintech to buy right now that's not SoFi Technologies. So this particular author is very bearish and negative on SoFi Technologies, and he's going to compare SoFi Technologies to another fintech company, and of course I'm going to be adding my opinion on that because I think SoFi Technologies is a very good fintech company to buy right now. So we're just going to see what this author has to say, and then lastly we're going to go over a very critical article of SoFi Technologies because I want to give you the tools and the information regarding the bullish positive side of SoFi as well as the bearish negative side so you can make an informed investment decision. Always make sure to do your own research. As always, I'm a bull on SoFi Technologies. I do like this company, but I don't have more than a 5% exposure to it because I don't invest into single risky growth stocks more than 5% initial allocation. But for more videos on SoFi Technologies regarding their latest news updates, price targets, price predictions, as well as stock analysis, remember to go and comment down below that you want more videos on SoFi Technologies. Subscribe if you are new, and without further ado, let's jump right into today's stories. Also, if you want to know the best stocks that I am buying right now, feel free to become a member and hit that join button right next to the subscribe button to get more perks. But with that out of the way, let's jump right into today's stories. Recently, you've probably noticed that the SoFi stock price has dropped from around $6.89 down to the current stock price of around $6.15, which is around an 11% drop in price recently, which is exactly what I was talking about in a previous video that I uploaded regarding how the SoFi stock price was actually going to pull back and correct because the SoFi stock price was somewhat overvalued based off of the hype regarding their earnings report and how the stock price surged too quickly, so naturally we should have anticipated a pullback. Right now, professionals believe that the company is worth somewhere around $7 and $11 over the next 12 months, which indicates that right now, technically, the current stock price is undervalued compared to various growth metrics. But the last article that we're going to talk about actually thinks that SoFi Technologies is somewhat overvalued right now. But we will talk more on that later. So why has the SoFi share price actually fallen in their overall price recently? So what happened? Well, in essence, shares of multiple fintech companies and growth companies, not just SoFi, has pulled back recently. For instance, Upstart Holdings fell by around 10.3%, and Rocket Companies also fell by around 10.8%. So what's going on? Well, the main reason for this is that the Federal Reserve, who was trying to increase interest rates to get inflation under control, is still very hawkish, which means that they anticipate to continuously increase their interest rates in the prime rate so it can get inflation under control. And right now, the Federal Reserve has no proof that inflation is coming down or becoming under control, so they are going to continuously raise the interest rates. Jerome Powell even said, and I quote, "While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses." He goes on to say, "These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain," end quote. And honestly, I am 100% on board with his approach to inflation. Inflation is far more dangerous than rising interest rates, so continuously pumping up the interest rates to get inflation under control is necessary right now, otherwise we could have an economic collapse. Now, this isn't bad news for SoFi Technologies, and here's why. This is only bad for companies who have a lot of debt on their overall balance sheet, and right now SoFi has long-term debt of around $3.7 to $3.8 billion, but here's the kicker. Because SoFi Technologies is a bank or a fintech company, that means that higher interest rates are actually going to be better for this company than other companies because they get to adjust their rates that they are giving people, which will offset the cost of inflation. Because as the Federal Reserve increases their interest rates, SoFi and other banking institutions can also increase the rates that they are giving out on their loans, and that's going to offset the cost for them. This is why in times of increasing interest rates as well as high inflation, investing in financial companies as well as healthcare companies are going to be fantastic defensive plays that will maintain value in your overall portfolio. Even during a severe recession, inflation, SoFi Technologies is a very stable company that could continuously increase their overall loan growth as well as the amount of customers that they are bringing in, because they are rapidly increasing on the amount of members, which is going to increase their overall products and thus reflect very positively in their revenue, which will lead them to profitability, which we will also talk about later in the video. Right now, I'm actually surprised, along with the author of this article, he is also surprised how the market has acted harshly to what the Federal Reserve is thinking. It's not like Jerome Powell or the Fed was all of a sudden going to turn dovish because inflation is still running rampant, which means that we actually need higher interest rates. This is short-term pain, which is going to be very good for the economy in the long term. That's why I remain bullish on SoFi Technologies, and I do believe this is a very resilient company that is going to continuously increase their overall compounding annual growth rate in terms of their revenue, and I think they're going to increase the number of members that they have. So overall, this company is very resilient in times of either a recession, a stock market crash, or even rising inflation and interest rates, which is very good for various investors. But echoing the author of this article, I and the author of this article are both bullish on SoFi Technologies because I think they're actually going to do very well over the long term. And just like I predicted, the company will pull back temporarily to surge over the long term. Now, despite very good news overall on SoFi Technologies, particularly regarding their strong financial results, what is the best fintech company to buy according to this author? Well, he says that he really likes PayPal much better than SoFi Technologies, and I'm going to agree to disagree with him here. Yes, clearly PayPal is a more stable and a more successful company, but that's because SoFi is just getting going. PayPal has been around the block and they've been around for a bit. So I think it's actually unfair to compare SoFi Technologies to a company such as PayPal or even Block for that matter. Now, I do agree with the author that SoFi is a financial market disruptor, and that's why I am bullish on this company, because I think this company is going to make a fantastic fintech company in the future. Now, he does go on to compare both of these companies, which I respect. However, I think he's setting up a false dichotomy here where he's saying that investors should either only buy PayPal and not buy SoFi Technologies, and the investors who are buying SoFi Technologies should jump over to PayPal, or they have to choose between the two, and I just don't see that. I personally hold both PayPal and SoFi in my portfolio because I think both of these are good companies objectively. He points out that both SoFi Technologies and PayPal have dropped in their share price pretty dramatically. Basically, both of them have been cut in half, where SoFi Technologies declined over the last year from around $15 down to $7, while PayPal was around $195 and it's dropped to around $100. He also points out and highlights that PayPal has a trailing 12-month price-to-earnings ratio of 53.5, which is definitely high. Clearly, PayPal is technically trading at a premium, but they're substantially cheaper than what they were trading at before the stock price fell. But he compares this to SoFi to say that PayPal is better than SoFi just because SoFi doesn't have a PE ratio or a price-to-earnings ratio, because SoFi is not a profitable company like PayPal is. He also highlights how some institutional investors are selling SoFi Technologies, while other institutional investors, such as Elliott Investment Management, has been busy buying and increasing their stake in PayPal, where Elliott's stake right now is worth around $2 billion, and it's a very confident position in PayPal. Before we get into this very negative article, I want to highlight that the author is just a critic of SoFi Technologies. He has had around 5 articles of this company, and all of them have been very bullish, which is why he indicates to sell the company. And if you're planning to hold this company for the short term, I don't blame him. I understand how, while the stock price is falling and crashing, that you would want to sell the company. But if you are a long-term investor like I am, and you see the future potential of this company, then there is no real reason to sell the company right now, mainly because I'm impressed with their over 30% CAGR in terms of their revenue growth, which is around 52.72%. So anything above a compounding annual growth rate of 30% to me year over year, especially if you can do that for the next 3 to 5 years, is extremely impressive. And I think SoFi Technologies is going to do that. So here's what I want to bring to investors' attention to totally dismantle this author's article. So he says basically that the Japan-based company named SoftBank is liquidating their SoFi shares. However, he even admits in the article that this has little to nothing to do with SoFi Technologies' performance, and that's something that we need to highlight, because a lot of investors are liquidating SoFi and running for the hills when this institution is not selling SoFi because they believe SoFi is a bad company or because SoFi isn't delivering impressive results, but rather because SoftBank as a company needs to liquidate companies because they are having a large problem with losses and they need money right now, and that's why they are liquidating their shares. Because because if we look at various SA authors, they actually advocate a buy rating for SoFi Technologies. If we also look at Wall Street analysts, they also say that this company is clearly a buy rating right now. So what are the core problems that this particular author is trying to highlight? Well, he says that SoftBank is used to investing into very high growth speculative companies because it gives them phenomenal returns, where they are investing into companies like SoFi Technologies, WeWork, DoorDash, and Uber Technologies. However, I want to point out that because SoftBank is selling SoFi, it only has to do with SoftBank. This doesn't have to do with SoFi Technologies, for instance. SoftBank is also selling other companies in their portfolio. Why? Because they need cash. Right now, they are actually reevaluating the way they invest into various firms, and they are revamping their investment strategy because during the last couple quarters and the last year, they have had record losses of around $23.1 billion just in the second quarter. Imagine losing $23.1 billion in a single quarter. Clearly, you are struggling for money right now, and you need to liquidate some of your investments, not only for risk management reasons, but also because they need capital. So again, some institutions are selling SoFi only because the institution is doing bad, not because SoFi Technologies as a business or company is doing bad. We actually see the exact opposite because in a previous video, I highlighted how BlackRock, Vanguard, and even institutions like JP Morgan are investing more into SoFi Technologies, not pulling or liquidating their positions like SoftBank is doing. SoftBank has sold around 49.9 million shares of SoFi in August, but they still have around 45.4 million shares of SoFi, which represents a 4.9% equity stake in the company. So clearly, this is still a large position, but depending on how SoftBank operates in the future, they may sell the rest of their SoFi shares and their SoFi stake. But overall, I don't think this is a good point to say that SoFi Technologies is bad just because SoftBank is doing poorly and that's why they're selling. So I totally disagree with this bearish author on that point. The second point I also disagree with him at is SoFi's relatively high short interest. So their short interest peaked at around 22.8%, then it fell as of August 15th down to around 16.8%, and then multiple weeks later, right now, the company is trading at a short ratio or short interest percentage of around 15%. And I do think that is rather high, which indicates that investors or institutions or anyone that wants to short this company thinks that the company is too high. But overall, because this is a growth company, you're betting that the future stock price is going to be well above what the company is trading at right now. For instance, I am buying SoFi right now at around a 4 to 5% allocation to the company because I believe the future stock price in the next 5 to 10 years is going to be substantially greater than what it's trading at right now. I also want to point out that SoFi's PS ratio is only around 4.5 times, while other companies like PayPal is around 4.13 times. So already their PS ratio is relatively close, so if SoFi continues to fall lower in their overall valuation, I think this is actually a positive thing for SoFi because not only do long-term investors such as me and others get to buy this company for cheaper, it allows us even further upside in the future. So I actually completely disagree with its author. I am not bearish on this company. I'm very bullish on this company, but again, my proper risk management and my risk management policies will not allow me to allocate more than 5% allocation to this company because I have plenty of other phenomenal growth stocks that I am buying right now, and I don't want to over allocate myself just to one single growth company in the fintech space, which is really not doing so hot right now, but I believe in the future it will be. But I would love to hear your thoughts down below. Remember to go and smash that like button right now, subscribe if you are new, tell me in the comments if you want more updates on SoFi Technologies, and with that being said, I will see you in the next YT video.